All right, so let's get started with the first segment. It's about passive mutual funds. And before I introduce my guest, let me tell you a little bit more about what this is. Now, a passive mutual fund is essentially a type of mutual fund, whereas in an active mutual fund, you have a fund manager that decides on an ongoing basis which stocks in an equity mutual fund should be bought and sold and what the constitution of that mutual fund should be within certain overarching rules. A passive fund essentially tracks a benchmark, like for example, the Nifty 50. So if the Nifty 50 has 50 constituents, a passive fund that tracks the Nifty 50 will have 50 constituents. And the proportion of those stocks that are held in that passive fund will be on the basis of the ratio of market capitalization in the case of an index fund. So for example, if Reliance Industries is 15% of the Nifty 50 on any given day, you have a passive fund, an index fund that tracks the Nifty 50 that will have 15% of its assets in the form of Reliance Industries, and that gets settled on a daily basis. So now you know what a passive mutual fund is. Let me get on my guest now. We've got Harshvardhan Roongta, who is a certified financial planner as well as the co-founder of Roongta Securities. Harsh, I've laid the context, first of all, and thank you so much for joining me today. I've laid the context. This conversation or this argument between passive versus active as a school of thought has been raging for a little while now. But is all of this black and white? Is there choosing just one over the other, or is there a case of using both?
Well, Alex, thank you very much for having me on the show, and it's always a pleasure to be on the Money Show. Well, coming to the question that you asked, I mean, if you look at the latest SPIVA report of June 2021, you will notice some kind of data which is available. So it goes on to say, if you look at particularly the equity market and the equity segment, you will see about 86% of large cap funds have underperformed about 57%. So if you have such large quantum of underperformance of active funds underperforming the indexes, I'm sure you will have this question which you have just raised as to, has the time come for passive investing? If you were to extend this data for a longer period of time as well, you will find that underperformance of the active funds is much more, the proportion is much more than the passive funds. However, having said that, I still believe that there could be some pockets of market segments wherein you can generate alpha, and there is a case for having a mix of both, as you rightly asked, whether it's either or. No, it's not either or. When you construct a portfolio, there are different components to your portfolio. Some would be, say, a large cap, some would be mid and small cap. There is a scope for thematic sector funds as well. So putting all in all together, if you're investing and allocating towards large caps, it most certainly makes a case to invest into passive funds. But as an overall portfolio, there is some room to invest into actively managed funds because of the information dissemination process that we look at in a country like India. So I think there is some scope there as well.
Okay. From the perspective of portfolio construction, and I'm primarily talking about equity now, and taking from what you said, one would think that in any case, when the layperson looks at the markets, the equity markets, they tend to look at the Nifty 50 or the Sensex as a barometer. You had the Nifty 50 Harsh hit 18,000 today, and a lot of people who had invested at the low point of last year will be extremely happy with the kind of performance so far. So in any case, that is the barometer. Would you then say that it should form a large part of the core of your portfolio, that you should have a core and satellite allocation?
Yes, in fact, Alex, if you recall, we've been continuously speaking and maintaining a stand that a core portion of the portfolio, so assuming an investor puts in an X amount of money into equities, nearly 50% of that investment should go into the good quality companies, the large and the blue chip companies of the country, essentially the top 100 companies as a market capitalization. So if you were to look at a large cap allocation, which forms the core portion of your portfolio, we have the report in front of us. We have performances which we've been tracking, which clearly goes on to say that the passively managed funds have done much better, especially in the large cap category. So if you're looking at a core allocation, which has large cap as primarily the portion of your investment, then most certainly you would look at a passive investment. So Nifty 50 is one such option. You have a Sensex 30, which is also an indices, or even you could even look at a Nifty 100 for that matter. So the large cap companies forming a core portion of your portfolio, and that core portion can be entirely invested into a passive fund.
Okay. Now, of late, there have been, or rather, actually, before we get that, let's talk about debt as well. Okay, before we get into the pros and cons of investing into passive. You've already discussed, of course, some of the pros, but let's talk about debt, because this is something that I think has been relatively newer than the passive equity mutual funds. There are a lot of options now available in debt as well, Harsh. How do they work?
So Alex, you're right when you said that there's a lot of, flavor being catching up on the debt side as well. So essentially speaking, on the passive side, debt funds will come in two types. So one would be, of course, a passive fund with a fixed maturity date. So you will have a bond fund, say, which has a targeted maturity kind of a fund, which says that will mature in 2026 or 27 for that matter. You have a Bharat bond ETF, which has a tenure specifically mentioned that it is up to a X period. So these are passive funds which track an index, which track the index and invest into those components of that index, which will have a maturity up to say 26 or 2026, 2027. The other kind of a passive debt fund that you will have will not have a fixed maturity date. So, but they could be a 5-year gilt fund kind of an example, wherein the bonds in which they invest, the gilt securities that they will invest into, will have a constant maturity of 5 years at all point in time. So they don't have a fixed maturity date of the scheme, but the underlying investment that they have will have a tenure of 5 years constant maturity. So these are essentially two different types of passive funds. Now, how do they work? In that sense, if you see, as I said, they will invest in the components of that index. And looking at the current offerings that have been given by all the mutual funds to the investors, you see that the construct of that portfolio is essentially into either government securities, which is gilt. You will either have state government bonds, the state development loans. You will have the PSUs, which they invest into only PSUs, or they'll have AAA rated corporate private companies. So the idea being that an investor somewhere needs to be assured that there is very less credit risk and there is a visibility of a return that you will get. Though of course returns are not guaranteed, they're not fixed, but at least if you're investing in a product which has a fixed maturity date, you will know the yields that you will get if you hold on till maturity. So a passive debt fund also fits into a profile for all those individuals who are not wanting to take, who rather want to know exactly what kind of papers are being invested into. So I think it's a very interesting space, and there is scope for investors. It is trying to solve some kind of a problem which we've seen in the past in terms of no clear outlook on the credit risk that a fund as a scheme has been taking. So in this case, yes, there is a lot of development, and of course, we're at the tip of the iceberg right now.
I'm sure, and I'm sure that the offerings that come up also in the future will suggest just that. I want to talk about now in the Indian context. There are two options. I spoke about index funds when I was trying to explain what passive funds are to those that are not familiar. But there are essentially two options one would consider, right? Broadly, you would talk about index funds and you would talk about ETFs. How would you say an investor should ideally approach this if we're talking about holding these things for the long term? Would you say in the Indian context it is better to hold index funds, or do you think ETFs should be considered based on the cost factor?
Well, Alex, when you look at the components of the ETF or the index fund, if they're tracking a particular index, you will find the constituents being the same. So the papers that they invest into are going to be the same. It's only a matter of convenience. So while you are investing into ETFs, which is exchange traded funds, you will need to essentially mandatorily have a demat account. You will need to route or the buying and the selling of these through the stock exchanges, wherein you have to be registered with a stockbroker, and then the transactions, then the investments and the redemptions will happen. Whereas in an index fund, you do not need a demat account. You can simply go about investing into those similar to how you've been investing into any mutual funds, wherein you get a statement of your holdings and the units will be held by the fund houses in their books. So it's purely a matter of convenience. Of course, there are different elements to this in terms of the expense ratios, in terms of a couple of other things, the applicable NAV. In case of an ETF, you get a real-time NAV on the market. Whereas in terms of mutual funds, the index funds that we're talking about, the applicable NAV is at the end of the day. So barring those minor nitty-gritties, it's more to do with the convenience of the investor. If you're comfortable investing through a stockbroker, through your demat account, then most certainly ETFs. If not, then index funds offer that particular convenience of investing.
Okay. And there's also a point that you had made, I think, when we'd spoken earlier, where you said that SIPs need to be routed or are more convenient through an index fund rather than an ETF. But let's talk about the broad advantages and disadvantages of the schools of thought, right? Or the styles of investing, passive versus active. Let's talk about the advantages first, Harsh. What, according to you, are the key advantages?
Well, Alex, simply put, if you're putting into a passive fund, be it equity, be it debt in that case, I mean, of course, the costs are going to be lower because there is no fund manager involvement in terms of, identifying the stocks or managing credit for that matter, durations in the debt funds. So the cost of investing into a passive fund is very low as compared to an actively managed fund. You will find there is, the returns that you generate will be in line with the general market. Wherein in an actively managed fund, you will always have that concern whether your fund is performing better than the market or is underperforming. So if you're investing into a passive fund, you know for sure whatever the market returns have been minus the expenses is what you have actually got for yourself. You don't need to monitor any of those investments. You don't need to be worried about the fund manager's ability. So you're just very, as the word says, passive. You just relax. You get what the market is giving to you for yourself. As I said, there is no monitoring, tracking required at your end, so there is less of effort that you need to put in also. So putting all this together, yeah, of course, low cost, your returns are in line with the.
Okay. All right. It seems like we've lost Harsh's feed, but he was talking about the advantages of passive investing, and he was talking about the fact that the costs of passive mutual funds are generally, particularly if you're talking about equity, are much lower than actively managed funds because it's not actively managed. There's no fund manager intervention, is what Harsh was just pointing out. Harsh, you were talking about the advantage in terms of the cost. So there's definitely a lower cost. Generally, would you say that, or would you be able to give us a range and the difference between active versus passive?
Well, if you look at a passive funds, I mean, they would, in the equity side at least, they would start with say about a 10 to 20 basis points, going up to 30 or 40 basis points. Whereas on the actively managed fund side, the expense ratio could be anywhere in excess of 100 basis points. So yeah, the cost would be, in my opinion, a broad way to give a sense. I mean, you could look at something like a one-fifth of a cost structure when it comes to passively managed fund as compared to the actively managed.
Okay, and some of the other advantages that you were pointing out?
Okay, so if you look at to, if you were to consider the advantages that an actively managed fund could give, I mean, it's only the potential of an alpha that the fund manager will generate. So while an index fund, for example, a Sensex has returned, say, about a 15% return on a long-term basis, a few actively managed funds could have the potential to generate probably 18 or 20% return. So as an investor, my advantage of going into an active fund is the potential ability of generating an alpha by my fund manager. But of course, the confusion still remains as to saying which fund manager in the future will generate alpha. If I would know that, I mean, most certainly all of us would stick to active funds. And in the absence of that assurance, or rather the probability of an ex fund manager generating an excess return, I think people would want to stick to index funds in that time.
Absolutely, and there has also been an argument in certain cases, Harsh, that to a large extent the portfolios that are maintained, at least on the large cap front, are more or less similar to the constitution of the Nifty 50. Maybe not in terms of the percentage allocation towards each of these constituents. But I want to also ask you about your picks. So if one was to consider index funds or ETFs in equity and passive mutual funds on the debt side, what according to you are the ones that they can consider?
Well, you rightly said, Alex, that within the large cap category, I mean, it makes all the more sense to go into passive funds because the universe of investing into this stocks is 100. The top 100 companies fall under the large cap category. So within the large cap category, passive funds make a lot of investment sense. The picks that I would have within this category would be an ICICI through Sensex Index Fund. That is, in case you're looking to invest through Sensex 30. One from the Nifty side would be an HDFC index fund, the Nifty 50 fund, is what you can consider when you're looking at Nifty 50 for that matter. Uh, the broader market, if somebody wants to cover the entire market, wherein you're not looking at only top 100, top 30, or top 50 companies, you could look at an, Motilal Oswal Nifty 500 fund. So this essentially would invest into the top 500 companies of the country. Now this includes your large cap, mid caps, and even the small cap. So you have 100 large cap, 150 mid cap, and 250 small cap companies comprising invariably representing the entire Indian economy. So that's a broader index that a person could look at. Well, from a debt point of view, I mean, if you're looking at any passive funds, well, as I explained, there are a lot of combinations available. You could have a passive fund with a predefined maturity. Without a predefined maturity, you would have several different combinations of just government bonds and a PSU. You would have state development bonds with a AAA rated corporate bonds. So lots of combinations are there. Very difficult to pick any specific favorite. But I would recommend that all investors looking for passive debt funds should actually go and sit down with their planners, understand what the constituents of that passive fund is, match it with your time horizon, and then invest. So unable to give you a particular name in this category, but yes, of course, look at something which matches with your maturity period, time horizon, and the underlying paper should be in line with what you're expecting.
Okay, Harsh, do stay with us. As promised, we are going to take queries in just a short while, but we have to slip into a short commercial break before we do. Do stay tuned. Welcome back. You're watching The Money Show. Now, as promised at the start of the program, we are going to take a few viewer queries. And by the way, in case you're interested in getting your queries answered, you can write to us on any one of our social media platforms. Now, the first query that came in, and by the way, we're speaking to Harshvardhan Roongta, who's been kind enough to stay on to take all of your queries. The first one is from Ramakant Dubey, who points out that he's a senior citizen. He's asking if he can invest a lump sum in a balanced advantage fund in the present time when the markets are at all-time highs. Now, this is increasingly a concern that is being raised, Harsh, by people who are invested or have been invested in the equity markets, and this is now the fear that there will be a sudden crash and you will lose a certain amount of money. Is it smart, is it prudent to allocate a certain amount of money towards a balanced advantage fund at this point?
Yes, most certainly, Alex. I mean, in fact, the balanced advantage funds or dynamic asset allocation funds, as they are interchangeably used, I mean, they're particularly, designed in such a way that, you could invest. He's being a senior citizen. Mr. Ramakant Dubey says he's a senior citizen. So, the market valuation being one of the concerns, the balanced advantage funds have been designed in such a manner wherein the equity allocations are calibrated based on a certain predetermined model. So you will have one set of underlying matrix being predefined, saying that if the market valuations are at a X level, the equity allocation will be say 40. The markets, the underlying matrix changes, and the equity allocation changes accordingly. However, not all balanced advantage funds use the same underlying matrix. So any investor wanting to put into balanced advantage funds at this juncture need to understand the difference. So let me give you that difference with an example. One of the oldest balanced advantage funds, which is of the ICICI Balanced Advantage Fund, uses the investment model, which is nothing but a trailing price to book model. So they say that the matrix will determine how much equity they will invest into is dependent upon the trailing price to book ratios. So currently, based on the matrix, they have an allocation of equity to up to about 40%. And all other fund houses which are using this counter cyclical method of investment model would have an investment between 30 to 40%. On the other hand, we have something like an Edelweiss Balanced Advantage Fund, which uses, it's more like a pro-cyclical kind of investment model. And their allocation at this juncture would be 70%. So you cannot strictly compare a fund which has about 30 to 40% in equity with another fund which has about 70% in equity. So any investor looking to invest into balanced advantage funds needs to be mindful of the underlying investment model, and please pick a one that suits your investment and not just simply looking at what probably a returns or a past returns have been in this particular category.
And the other thing to bear in mind, and I think this was a conversation that we'd had, if I'm not mistaken, Harsh, a couple of years ago, or maybe a year and a half ago, which is the holding of the debt also, the papers. It's not really specified that they need to hold absolutely high value papers or AAA rated papers. So therefore there was a bit of a question that was raised by one of the large investors in one of such a fund. So do you also encourage prospective investors to look at the holdings of those papers?
Yes, most certainly, because we're talking about investing lump sums into BAF. So of course, one is the matrix which has been used for determining how much equity gets allocated towards the scheme. There has to be some mind put to also the quality of paper. But however, let me caution you at this juncture that generally speaking, we've seen that all the BAF schemes would have only highly rated papers. So I don't think that there would be a case wherein a credit risk kind of a investment product would be invested into a BAF scheme. But nevertheless, having said this, I mean there is no harm in being alert, being informed, and looking at the debt papers as well.
Understood. All right, let's go to the next question. Now, we've got Krishnan CP who is asking which mutual fund category would be the best to invest in that would provide a retiree with a steady monthly income stream through the SWP mode, considering safety of capital, efficient taxation rate, and a decent CAGR for capital appreciation. So it's a little bit difficult because you wouldn't think that a debt fund would give you a significant amount of capital appreciation, but then the safety element is there. Is there something that ticks all of those boxes?
Mr. Krishnan was looking at a couple of things, which is rightly so. I mean, there's no harm in looking at a product that gives you a 360-degree solution to all your needs. But the conservative hybrid fund, that he's looking at, and he also mentioned that he wants efficient taxation rate. So a conservative hybrid fund has a mandate to invest between 10 to 25% into equities. Now, as a result of this, the conservative hybrid fund falls under the non-equity category for taxation purposes. Now, if you are in a non-equity category, of course, the tax implications are going to be much more. So we just spoke about balanced advantage funds. Now, this is one investment product which Mr. Krishnan can consider so that it ticks off all the category, all the checkpoints that he's looking at. Now, what happens in BAF, as we spoke about a situation wherein the equity allocation in a counter-cyclical kind of an investment philosophy would still have about 30 to 40% into equities, into pure equities. There is one exposure that the scheme takes into arbitrage strategies. Collectively put together, the pure equity investment and the arbitrage strategy, you will see that the equity and equity-related investments are to the extent of minimum 65%, which makes it eligible for an equity taxation. Now, so this brings in that element of preferred taxation, along with the possibility of the capital appreciation at the same time, not investing all the corpus into markets at a high valuation. So I think these are this is one category that Mr. Krishnan can consider. Some of the schemes that I could recommend, I could give 4 names which he can look at. Depending upon his investment amount, he can choose either one or more schemes. No need to take all 4 of them. These are just 4 good names that I can recommend at this juncture. One is, of course, the ICICI Pru Balanced Advantage Fund. Kotak Balanced Advantage is another option. DSP Dynamic Asset Allocation, and Aditya Birla Balanced Advantage Fund.
Okay. Harsh, now I would have absolutely loved to take a few more queries, but unfortunately we're running out of time. I think we'll couch the rest and we'll keep them for another date. But thank you so much for joining in and for having that lovely conversation with me about passive investing and also solving the queries for Mr. Krishnan as well as Mr. Ramakant Dubey. It's been an absolute pleasure speaking with you.
The pleasure is also mine. Thank you, Alan.
All right, on that note, we're slipping into a short break. But on the other side, we will speak about credit cards and how you should use them as a tool and avoid them becoming a liability. Do stay tuned.